Hello, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report coming to you on Mother's Day here in Central Florida. And first off, of course, a tip of the proverbial hat to all you moms out there. So, we all know getting a child from 0 to 21 is not an easy task, and it's not always filled with hallmark moments. There are plenty of poopy diapers and lippy teenagers and everything in between along the road. So, thanks, moms, for all that you do, and I hope you guys are all having a wonderful Mother's Day out there. Anyway, this week we're going to talk about a couple of things. We took last weekend off, by the way. The birthday celebration ran over, and we just couldn't fit the time in. We had a delightful weekend with the family, getting a little older still, I guess. Anyway, this week we're going to talk about a few things. I want to lead off with Jeffrey Gundlach's comments at the Irasan Investment Conference on the housing market. Now, the same day that he made these comments, and what he said was, there's no first-time buyers out there. The kids are not all right, Mr. Gundlach told the folks at this investment conference. There's no great jobs being created out there right now. Most of the job growth that we're seeing, particularly in the younger first-time buyers age group, is very much part-time, lower-paying jobs, not the kind of jobs that have you out running to buy a new condo or a brand new home when you're 25 or 26 years old. He also pointed out that most people are still, particularly the younger ones, are scarred by the recent housing crisis. They saw their parents and their older siblings lose tons of money in their housing investments. They bought a house in 2006, 2007. Awful lot of them went into foreclosure. A lot of them are still underwater. They just don't have any real interest. Renting has more appeal to the younger generation right now than buying does, according to Mr. Gundlach's comments. And I originally filed those comments away and considered them, but didn't really think about it too much. So a little later on, I took my 25-year-old son, who does live with us, just started a new career down here in Florida, is off to a great start. And we dropped his car off at the auto body shop, and it's about 7 miles away from the house. And on the way back, we ran along the edge of town on a back road back. And once you get outside of Windermere, you're pretty much in a rural district, lots of citrus, cattle, that type of thing. And as we're getting back closer to the house, he said, Dad, in a couple of years, when I'm finally ready to buy a house, I'm going to be able to get it pretty cheap. Now, my son has a great head for business, and he's an extraordinary salesman, but he pays no attention whatsoever to markets or the economy or any of that stuff. So I said, what makes you think so? He said, look, just in this little drive back, in 10 minutes, we've passed 10 new home developments. Who do they think is going to buy all of these houses when they're done building them? Now, out of the mouths of a 25-year-old babe, he's exactly correct. There's been a huge distortion in the housing market in the last 2 years. And I'm a little shocked that the builders have not seen this, that so much of the low to middle end market that's normally first time buyers has been institutions and hedge funds snapping up single family homes as a long term investment. Jury's still out on how well all of that works. But that's what's created the move up market that we have right now, the folks that are selling a house and moving into one of these newer, maybe slightly nicer developments. All that hedge fund and institutional buying has allowed the move ups to happen. Everybody's now pulling back. The single family home REITs have not worked as well as investors had hoped. Blackstone has stopped buying for the most part. I don't think they're selling or even close to selling in any large amount, but they have pretty much stopped buying, and they were the biggest buyer of single family homes out there, along with some of the other big hedge funds. Huge distortion in the market. The builders have overreacted to short-term demand for upper end and move up properties, in my opinion. There's way too much being built out there. It's going to take longer to work through that inventory than folks think. Now, Mr. Gundlach and I and my son are not the only ones to feel this way. Sam Zell jumped in at the Milken conference a couple weeks ago, and he says he thinks home ownership rates, already at a 19-year low, are going to continue to decline over the next several years. As people just prefer renting. And of course, we're seeing more of a move back to urban areas, which generally involves more apartment living. So the housing market, even Janet Yellen, by the way, did chime in. She says, look, the readings on the housing market are very disappointing. She's concerned about it. She's worried that housing, which was such a big driver of what little recovery we've had the past 2 years in the economy, is now slowing down. It's all a result of this hedge fund and institutional buying going away. Now, in addition to maybe putting some chicken shorts by using put spreads on the home builders, this has some really cool implications for us because we own and a lot of real estate related securities, and we love owning real estate related securities and companies that own a lot of property. Mr. Gunlack thinks that the market's going to go down and hit new lows. Now, I'm hoping that he's a little pessimistic. My own view, and I'm not really a great macro guy, but I kind of see it bouncing along the bottom. Yeah, my sister was building a house at Myrtle Beach, or was going to, and she found out that for what she could build a house for, she could buy twice as much in the existing property market. So she's dumping her lot, fired the builder, and they're just out of that game. They're going to buy an existing house now. And I think that's what's going to happen. I think the builders are going to get hurt here, but we'll see some tick up in existing housing sales as the few natural buyers that are out there decide, hey, I'm going to buy one that's already here rather than go through this hassle of building a new home. I think the housing market bumps along the bottom for a few years, and that's going to create some opportunities in real estate related securities, possibly in the mortgage REITs, and I think they're just going to bounce along and make the cash payments to us along the way. I'd be really surprised if any of our housing-related companies were to take a sudden, sharp move up in price. I'd love it, but I'd be surprised. By the way, what I just described is a perfect environment for an option writer. This is a great time, I think, on the mortgage REITs and other real estate related securities that are trading down near lows, paying generous dividends. This is probably a pretty good time to sell puts. If you get put to stock, collect a couple dividends, sell a call, and move on. I think you can generate a lot of income if you're inclined towards option writing right now. Just always make sure you pay attention to the valuation of the security that you're going to sell options on. That's first and foremost always, but it's a great environment for that in some of the real estate related issues, particularly the REITs with their very generous yields. So if you can add to that with options, I think you generate a high teens, low 20% return even in a static market for those things. So the other thing that we're going to be looking at very closely is, of course, the single-family home REITs. Now, so Silver Bay, American Homes for Rent, they came out to great fanfare, and everybody thought this would be a fantastic opportunity because houses were so cheap, and they did buy some houses cheap. They're not generating much in the way of dividends at this point in time, though. It seems when a house has been foreclosed for a couple of years and you buy it in a bulk purchase from the bank, nobody's been maintaining that property. So they've really struggled to get these things cleaned up, ready to rent. They've spent a lot more money on property management and maintenance than I think they intended to. The dividends have not been there. The excited initial burst from retail investors is just gone. Nobody cares about these things anymore. They're not quite cheap enough for us. Silver Bay's almost there at 90% of tangible book value and about 83 or 84%, I believe, of what management estimates net asset value to be. I need those numbers just a little bit lower before I want to get involved. A bad housing market could get us there in a relatively short period of time. Maybe we can pick some of these things up at 75% of tangible book value. American Homes for Rent, little more expensive, I guess, at 1.03 times book. And again, we just need to see those things come down around 75% of book. I think we'll get there in a weaker housing market. We're going to get pretty excited about those opportunities. So housing's just not going to be the place to be. I did recommend the other day establishing some January 2016 put spreads on some of the builders, some of the more leveraged builders. And I think that's going to work out very well. I just don't think they're going to be able to make a lot of money. It's going to get incredibly competitive out there. Margins are going to just shrink and go away as these people try to unload all of this inventory. And what they've built down here in Central Florida is just ridiculous. I've talked to friends in some other areas of the country, and it's pretty much the same thing. Way too many developments going up. There's no way there's going to be enough first-time buyers to allow move-up buyers to meet that demand for at least several years. So anyway, our other big news of the week from a value perspective, adopting the private equity mindset that we like to use of buying cheap assets and holding them for a long period of time. So one of the most interesting earnings calls of the season came from Apollo Global Management when Leon Black and Josh Harris talked about where they see opportunities in the world. Very interesting. They came up with the shifting financial services environment. Everything's changing there rapidly. We know that because we're a big player in the small community bank stocks. That landscape is changing. It's changing pretty much forever. There's going to be massive consolidation in there. There's going to be some great local banks that are able to take on the large banks in certain local communities. They're going to prosper wildly, but the landscape's going to change, and there's money to be made for long-term patient investors in this changing environment in financial services. The community bank trade is just one of them, but it's our favorite because we think it's got very low risk. It's a very boring way to make an enormous amount of money in the stock market. So that was one area that they talked about. The other that they talked about was shale oil fields. And we're starting to hear more and more about this private equity money taking the long view, getting into these things while they are extraordinarily cheap. We're buying some of these stocks at 50 and 60% of tangible book value right now. There's an excess of natural gas. Everybody's trying to get their oil and liquids mix compared to gas higher than it is currently. It's created enormous opportunities. It's a pretty solid, well-run companies. They're trading at well below tangible book value. Insiders are buying them. Institutions are buying them. Deals are getting done. And 10 years from now, these stocks are just going to be a lot higher than they are today as we figure out how to use more natural gas along the road to energy independence and getting the economy moving again. Why the administrations have not gone in that direction is beyond me, but that's above my pay grade. I'm not paid to talk about politics here. So let's hope that eventually we do start to use more natural gas, and we need to start exporting the stuff and take advantage of the price arbitrage that exists between our gas and natural gas in other locations around the world. That's going to happen over the next decade. Demand's going to go up. Inventory levels are going to come down. The companies that have a large presence in the shale oil and gas fields here in North America are going to see their stocks go up by a factor of 5, 6, 7, and even 10 times over the next decade. It's a great place to be investing for a long-term investor. Now, the other area he talked about, and this is one that we've talked about a little bit, but not a lot, and that's people overvaluing liquidity. If you look at the public debt markets that are liquid, very easily tradable, very low yields, no real opportunities exist, even in the so-called junk bond markets, which are now yielding about 5%. No real opportunities there. However, in illiquid direct lending situations where the company or the fund directly makes the loan to a particular company, interest rates are still very attractive. There's still a lot of opportunity out there. And you've got some of these business development companies and other financial entities that are controlled by private equity firms and are co-investing alongside firms like Kohlberg, Kravis and Roberts and Apollo and others, where they're able to make and hold these illiquid loans. You and I can buy them in the public market. Indeed, we have them in a couple of our portfolios, particularly in the income portfolio. We have quite a few of them. It's a huge opportunity. Banks aren't making these types of loans. It's very difficult right now to float a new issue in the junk bond market unless you're in kind of that top tier. So in the middle market, there's lots of opportunity for these companies. They're making these loans. You've got to hold them all the way out through the pay process, but you're collecting some huge payments along the way. We're able to buy a lot of these assets at a discount to net asset value right now because, again, Wall Street's not really covering them. The business development companies were all just kicked out of the Russell indexes. That created some selling pressure and removed some buying interest. So there's some opportunities in that illiquid lending segment that you and I can take advantage of. Again, I don't know that I will see any rapid appreciation, but these things are yielding anywhere from 8 to 15%. Some of them even pay that dividend monthly. So they're very attractive long-term income holdings. Now, Leon Black and Josh Harris have been in this game for a long, long time. They've got ties all the way back to Drexel Burnham in the Mike Milken days. They know the private equity business, and they've proven it with outstanding returns over several decades. So these are the three areas where they're really focusing. And long-term, patient, value-oriented investors should be doing the same right now and looking at those types of opportunities. We do across our portfolios. We have a lot of energy-related names. We have a special letter devoted to just the community banks and that changing landscape. And we've been all over the illiquid lending area for several months now. I just think it's a very attractive place to be with your money. These guys are going to be there. We're going to try to get in alongside them where possible, because Apollo does run several publicly traded entities. I've been a big fan of them over the years. And when they drop to attractive prices, we usually like to step right in and buy them. So anyway, that's our view. As usual, we have no idea what the market's going to do next week and don't really care unless it collapses and gives us this huge inventory creation event where we can get a ton of our cash to work. Barring that, it's going to bump along. There's going to be all sorts of market moving stuff next week. We've got retail sales out. Janet Yellen's going to give a speech. I'm sure at least one or two other Fed governors will make some remarks that the market pays close attention to. we've got the Philly Fed and the Empire State out next week, and those both generally move the market one way or another if they exceed or fall drastically short of expectations. So there'll be some stuff to move the markets around. Maybe we'll get some opportunities. But I like our position right now. We're still holding lots of cash in the non-bank portfolios. Pretty good level of cash in the bank portfolio as well, with about 35% there. I like where we are, and we will see how next week plays out. Now, in the meantime, life is pretty good down here in Central Florida. My Baltimore Orioles are in first place in the American League East. We have the Detroit Tigers rolling into Baltimore this week, which does that set up some great opportunities for me to take money away from the guys in Detroit at the MarketFi offices when they try to back their Tigers against my Birds. Not going to happen. We follow up ending the week with the Kansas City Royals. If you're a reader, this is one of the best times of the year. All the publishers are bringing out their summer reading list. So if you're a recreational reader, in the last couple, and I'm a huge one, we've had Natchez Burning, which I've read and is a fantastic book by Greg Iles. It's one of his best so far. If you like the lawyer mystery genre, I highly suggest that you pick that one up. John Sandiford was out with another fantastic offering in the Lucas Davenport series. It's one of my long-term favorites. Ace Atkins has picked up the mantle from Robert Parker on the Spencer series. Nobody's ever going to do it like Parker, ladies and gentlemen, but they're pretty good books. I did get a chance to read it. I enjoyed it a lot, and I highly recommend it. This week, we have Craig Johnson out with the newest entry in the Longmire series, another recreational reading favorite around here. So I'm looking forward to that. That'll be out on Tuesday. And if you look at the next 4 or 5 weeks of new releases in books, this is a great time to be a big reader, because there's just some wonderful books coming out across all genres, and even a few nonfiction titles that look kind of interesting. So visit your local bookstore, Amazon, wherever you buy your books. It's a good time to be a big reader. And as you get into summertime, reading on the beach, by the pool, that's just perfect. So life is good. Markets will move. We'll react and take advantage. And I will talk to you next week. This has been Tim Melvin of the Tim Melvin Deep Value Letter. And once again, happy Mother's Day to all the moms out there.